Hello, everyone. Welcome to today's Monday Market Huddle with Secured Retirement. Today's strategy is required minimum distributions and a required exit strategy for those required minimum distributions. Today is November 7th. My name is Ryan Keeproth. Many people in the office just call me Keeps. So if you haven't met me yet, it'll be a pleasure to meet you when we do get the chance. The information and these opinions are subject to change without any notice. Any type of investing involves risk, including the loss of principal, and there are no guarantees. Our firm does not assume liability for any loss which may result from the reliance by any person upon this information or opinions. The information and opinions contained here are for general information only. It shall not constitute an offer to sell or solicit an offer to buy any security or investment. It's not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular need of any individual situation. You should always consult your financial advisor prior to making any decision based on specific information contained here. Our advisory services are offered through Secured Retirement Advisors, LLC. We're registered as an investment advisor with the SEC, and we only conduct business in states where we're properly registered or excluded from registration requirements. Our insurance services are offered separately through Secured Retirement Associates, LLC, an affiliated insurance agency. So again, this is all about required minimum distributions. I'd like to start just by explaining what an RMD is. It's essentially a certain amount of money that you're required to withdraw from your tax-deferred retirement accounts, such as your IRA or your 401k. You're forced to withdraw money from these accounts whether you need the money or not, as well as whether the stock market is up or down. Now, the rules for calculating your RMD are complicated. They can be very, very confusing. The amount of money you withdraw is based on a formula, takes into account your life expectancy, the account balance the previous year, your birthday, as well as a couple other variables. And now if you miss a withdrawal or you don't take your full required amount, you're hit with a 50% penalty. That's the highest fine levied by the IRS. So now required minimum distributions, they don't kick in until you turn 72, but you should start thinking about them and plan for them well in advance because they will impact your total income as well as how much you're going to pay in taxes. Now, if you don't plan for required minimum distributions, you could be forced into a higher tax bracket without realizing it. Could cause you to pay higher Medicare premiums and tax on more of your Social Security benefits or your other investment income as well. Now, you may be asking yourself, why are you required to take an RMD? Now, the answer is relatively straightforward. It's really because the IRS wants their money. You were allowed to put money away in a tax-deferred account for many years, not having to pay any taxes on it, not having to pay taxes on the growth and so forth. But now this money's accumulated and hopefully it's increased in value for you. And unfortunately, the government wants their share. So they'll take taxes out of that whenever you take the money out. And that's essentially why they do that for you. The government is committed to getting their tax money, so much so that they're going to impose that 50% penalty on the shortfall if the money isn't taken out by the deadline. Now, forget what you're told throughout your career about being in a lower tax bracket when you retire. Often people find themselves in the same tax bracket during retirement as they were in their working years because they don't have the same deductions they had earlier in life, such as a mortgage deduction, child tax credits, things like that. So if you couple this with multiple sources of income, such as investment income, as well as RMDs, pension income, you may actually find yourself with more income than you expected. So a lot of people call this the grand illusion, essentially. Now, because RMDs could push you into a higher tax bracket and cause you have to pay more taxes on your retirement accounts, it's been referred to as the tax torpedo, essentially, by Forbes magazine. The reason why is because the torpedo travels under the surface of the water and cannot be seen, but the impact is noticeable once it hits its target. So in a lot of ways, required minimum distributions are like a tax torpedo. You don't really expect them to hit. A lot of people don't plan for them, and then all of a sudden, out of nowhere, you end up getting a big tax bill. There's a lot of pitfalls for RMDs. They can be especially dangerous during a stock market correction or in a bear market. And it could be a large part of why you see huge losses in your IRA or your 401k. When you think about it, when the stock markets go up, stock markets also go down. Bear markets follow bull markets. It's the way it's been since the beginning of time. So it's not a matter of if the market goes down, it's just a matter of when. And we certainly have experienced down markets this year, not only with stocks, but also with bonds and supposedly safe fixed income as well. A sequence of return risk happens when you retire during a correction. or during a downturn in the stock market. If you retire when the stock market is dropping, the combination of market losses along with those mandatory withdrawals could cause you to burn through your retirement savings at a faster rate than you're expecting. According to CNBC, retiring in a down market can mean 2/3 less money for the rest of your life. So it can really have a major impact on things depending on when you retire, how you take your money out, and how you plan for that moving forward. So really, it's crucial to have a strategy that's going to work for your situation and really personalized to you, because everybody is so different. Now, another pitfall is what we call the marriage penalty or the widower's penalty. Now, we hate to say being married is a pitfall, but something that you should be aware of is that if you're married and you're taking required minimum distributions, should one of you pass away, the surviving spouse is going to have to take taxes and file them individually rather than jointly. Since the tax brackets are so much lower filing singly than jointly, typically about half, we often see this pushing the surviving spouse into a much higher tax bracket. Now, this is assuming the surviving spouse has an IRA of their own or inherited IRA from the deceased spouse. It's likely both spouses have IRAs, which are then left to just one spouse to have to manage and deal with. So now that we've explained the problems that RMDs might cause, you might be thinking is that if the government's forcing you to take money out of the account, there isn't much you can do about that, right? That's not true at all. There is a ton of different ways that we can manage and plan for that. This is really exactly why you do need a plan and an exit strategy for those accounts. The money that you're forced to withdraw are considered taxable income. It's going to push you into a higher tax bracket potentially. So you'll even be paying more taxes on your retirement account, Social Security benefits, as well as other investment income. And it could push you and trigger you to be in a higher Medicare tax bracket as well. So it's critical that you get in front of those required minimum distributions as soon as possible. And you should really start planning years in advance. You know, if you wait until you have to take your required minimum distributions, it may actually already be too late. Now, the best way to impact and reduce the impact of taxes on your required minimum distributions, or even eliminate required minimum distributions altogether, is to get in front of them as early as possible, generally in your 60s, or as soon as you quit working, you can start planning and preparing for that. The sooner you start to learn about it, the sooner you start to act on it, the more options you're going to have and the more flexible you're going to be. Now, one way to do so is to convert your traditional IRA to a Roth IRA. It can oftentimes be one of the best ways to eliminate your required minimum distributions completely. Now, you're going to pay taxes, obviously, when you do convert the funds from your traditional to your Roth IRA, but you're not going to be forced to withdraw anything when you're 72. They don't have any sort of required minimum distributions, and so that's going to be tax-free for you. Now, taxes are lower now than they've been in 40 years. So a Roth conversion could also protect you from future tax raises. You do need to be careful when doing a conversion, and certainly planning that out with somebody who knows what they're doing, such as ourselves, can help to make sure that you're not making the wrong decisions there, because there's just so many different variables. By converting too much, you could push yourself into a higher tax bracket. By not converting enough, you could be leaving some additional money on the table as well. So that's really where we come in. We can help with this analysis and really find that sweet spot for a conversion amount that's best for you and your situation, while looking ahead to what might change in the future and adjusting for those things as we go. Other options for reducing your required minimum distributions are donating the required minimum distribution to a charity and continue, or you could continue to work after your 72nd birthday. If you are in a 401k, oftentimes that's going to delay your required minimum distributions. Now, a trusted financial advisor can help you determine what the best strategy is for eliminating those required minimum distributions. Another option is going to be what's called a qualified charitable donation. I mentioned that a little bit earlier. It's when you transfer money from an IRA to an eligible nonprofit organization. Now, these distributions aren't taxable, but they do still count towards satisfying your required minimum distribution for the year. That amount is currently capped at $100,000 per year, and you don't have to wait till you're 72 to do it either. You can actually start doing that once you reach the age of 70 and a half. Now, lastly, I'd like to give you a preview of potential changes to required minimum distributions. Now, back in 2019, the Secure Act raised the age from 70 and a half to 72. The Secure Act 2.0, the sister bill, it's proposed right now. It's proposing to increase from 72 to 75. Not to say that that's going to be the case. That it certainly isn't law yet, but that's what the proposal is there. It's projected to be phased in over the next 10 years, so we're not exactly sure how that's going to come into play, but we'll definitely plan and prepare for that when we can. Now, while not having to take a required minimum distribution can be beneficial, it could actually end up just pushing the problem down the road and creating larger tax bills down the road, because the longer that you wait, the larger that account should grow to if you're invested properly, and that could certainly impact things as well. Secure Act 2.0 was passed with strong bipartisan support in the House last spring, but there hasn't been much activity on it since. It's widely expected that after the midterm elections, it's going to be picked up by the Senate, and we're expecting it to pass in December or January, but we really don't know for sure. We're going to keep you updated if it does pass into law and what that may mean for you. There have been several changes to tax laws that can complicate required minimum distributions, and a lot of retirees are going to have trouble keeping track of the rules over the next few years as things potentially change. So that's why we suggest that you work with an experienced financial advisor who knows these things, who's keeping track of these things, to making sure that you're not missing out on anything crucial. So that's the presentation this week, the Market Huddle on required minimum distributions and the tax torpedo. Next week is going to be about scoring your retirement and the 5 areas that we really highlight and help you plan for when it comes to planning and preparing for your retirement. We're here for you, obviously, so please give us a call. Phone number down below there. We'd love to run the analysis for you. And if you're a current client, certainly make sure that you get that scorecard and begin to understand and see how that may impact things. So certainly open to some questions. If anybody has any questions, feel free to jump into the chat box and ask away. All right. I don't see anything coming in, so I look forward to seeing all you folks here in the office in the next few months. We do have an office we're opening up in Woodbury as well, so certainly if that works more convenient for you, we can start to potentially plan to meet in that office as well. But give us a call if there's any questions. Other than that, have a great week, folks.